Hey class, we're going to take a look at Chapter 2, Accounting for Business Transactions. And the first thing we're going to take a look at are the steps in which we go through for processing these transactions, including source documents. And that's the important first step, is to realize that each of these transactions that are occurring for our accounting information are because of an underlying economic transaction that happens for one of these companies. And each of those transactions is going to have source documents that can be used to verify that transaction. For example, purchase from a supplier, there might be an invoice or receipt as a source document that could be used to verify that transaction and the historical cost of that transaction. After identifying the source documents as well as the transaction itself, we'll end up taking those relevant transactions and creating journal entries for them. We'll also use something called T account as a helpful aid, and we'll see those later on in this slide presentation. And ultimately, where we're going with this is building out those financial statements. So the individual accounts, if we think about the balance sheet having that accounting equation of assets equal liabilities plus equity, those are more of a umbrella type account that's going to have little sub-accounts under them. For example, assets are going to have individual accounts or individual line items such as cash, accounts receivable, and inventory and supplies and plant property and equipment under them. So we're going to organize those, and the organization for assets is going to be in terms of liquidity. So something that's more cash-like is going to go at the top, cash being the most, and something that's harder to get rid of, such as buildings, for example, the headquarters building, is going to go more towards the bottom of that balance sheet. For liabilities, they're going to comprise things that are using generally other people's money. And an example of this might be accounts payable, in which we're essentially using the supplier's money to fund inventory or supplies. We may also use the bank's money and have something along the lines of a short-term note payable or a long-term note payable. And we're going to organize those in order of what's referred to as duration. So something that would tend to get paid back the quickest goes to the top, something like accounts payable, which we may pay back in 30 days or 60 days. And then something like a long-term notes payable, which is due back in over a year, would be towards the bottom. And then for our equity accounts, we've got something along the lines of common stock, which might be money that's put in by the shareholder and they're given common stock in return. We may also have retained earnings, which is going to be revenue and expenses. And then over the course of time, how much of that is going to be kept into the equity account as retained earnings. And then dividends as far as the amount of money that's getting returned to shareholders. Now, in accounting, we do double entry accounting. So we're going to, if we make an adjustment to one account, there has to be an offsetting adjustment to the other account. And we use what's referred to as debits and credits to make sure that this happens. For example, if we have a T account here, that's going to be one of our helpful aids to work through this. If we have a T account that has debits on the left side, and that might be true of something along the lines of an asset, such as cash, we're going to have credits that we're going to list on the right side just to keep track the number of debits and credits that are occurring within this individual account. So we'd write cash where on this slide it shows account title, and then we'd have a beginning balance, and then we would, every time cash is increased, we would refer to it as debiting cash and list that transaction on the left side. Anytime cash is withdrawn, we would refer to that as a credit, listed on the right side, and then use it to set up what would be a beginning balance plus all the numbers on the left side minus all the numbers on the right side to get an ending balance, which we would post at the bottom left of that T account. Now, in knowing which ones are going to be on the left and which ones are going to be on the right for debits, and which ones are going to be increasing for debits and which ones are going to be increasing for credits, we look at our accounting equation here. So again, something like assets, we would list the individual account for that name. Debits we're going to post on the left, and that's going to be increasing. And the example I like to use for this is if you have a checking account at a bank, they might issue what's called a debit card. So if you put money into that debit card, you're going to list that on the left. It's going to be increasing, so you're going to be adding those to the amount in your checking account. If you make a withdrawal, the bank's going to refer to that as crediting that account, and it's going to be taken away, so it's going to reduce that amount. Now, the thing to keep in mind is this, we're still going to refer for the liabilities and equity of the debits being on the left and the credits being on the right, but whether it's increasing or decreasing is going to be the opposite. So for liabilities, it's going to be increasing in credit. An example here is if you had a credit card, so an amount that you may not have any money on the account, but by having the credit card, you're allowed to go out and charge money. So the more you use that card, and the bigger the number is, the more it increases, the more you're going to owe. So if you go out and create a bigger liability, that number is going to increase, and the credits are going to increase that account. And as you pay that amount off, you would be debiting that account or decreasing that account. And then for equities, it's going to be the same as liabilities. Liabilities, we're using other people's money. In the credit card example, maybe the bank's money. Equity, as the company's perspective, you're using shareholder money essentially. So money that is owed to the shareholders, as you owe more and more to the shareholders, you're going to be increasing. So you're going to be crediting equity for that. And as money gets returned to shareholders, for example, with a dividend, you would be debiting that equity account. So let's walk through a few of these transactions just to see how the double entry accounting works. And we're going to take a look at something called a journal entry first. So when we're journaling entry out one of these accounts, we're going to list the debit at the top next to the date. So if we were to receive $30,000 in cash from a stockholder in exchange for common stock, we would debit cash. So on our T account, we would list that on the left-hand side, so it's going to be increasing. And then we're going to increase the amount we owe shareholders. So we're going to increase the amount of common stock, so that's going to be a credit of $30,000 to the common stock. Now, one of the things we do with debits and credits to make sure that the double entry accounting occurs correctly is to make sure our debits match our credits. So we have $30,000 on the left-hand side, $30,000 on the right-hand side. So that journal entry would make sure that the accounting equation still holds. So the second transaction we have here below is a purchase of supplies. So here we're going to be increasing or debiting supplies, which is an asset, by $2,500. And then we're using cash to pay for those. So we're going to credit cash by the $2,500, which would be decreasing that amount of cash. So let's analyze the impact as well, looking at the T account. So here we've got our journal entry in the amber color at the bottom left, where we've got the debit of cash kind of posted next to the date, and then our indented credit to make sure we keep our debits and credits kind of separated there and make it clear, of common stock. We're going to go ahead and create those T accounts on the right hand side here where we've got our cash, and again we're going to have our debit on the left there, which is going to be increasing for the asset, and we've got our common stock down below it, which is increasing in credit. So we're going to have, if we were to think about it as a beginning balance and ending balance, we'd post the beginning balance of common stock on the right hand side and the ending balance on the right hand side. And because it's increasing, we would post those credits on the right hand side for the equity and the liabilities account. And then for cash, we would have beginning balance, ending balance on the left hand side, and increases or debits of cash on the left hand side. So looking through the supplies transaction here, we'd have that debit to supplies, creating a separate T account for supplies. It's an asset, so it would be increasing in debits, so we would begin on the left-hand side here. Cash, we already have a T account for cash, so we're going to use that credit, which is going to decrease cash, and post it on the right-hand side of that T account. So let's take a look at a few more of these and just see how that would unfold. So if we were to purchase equipment, equipment would be an asset, so we're going to have debits on the left-hand side, which is going to be increasing. And then we would be paying cash for that piece of equipment. So we're going to credit cash by $26,000, which is going to decrease the amount of cash, and we'll post it on the right-hand side. If we purchase supplies on credit, we're going to increase the amount of supplies by $7,100. So it's going to be a debit to supplies left-hand side for posting. Accounts payable is going to be a liability. So that is using essentially suppliers' money to help fund this. So that's going to be an accounts payable as a separate T account. We're going to post it to the right-hand side as a credit, and that account is going to be increasing in credits. So if we provided services for cash, we're going to receive cash for our services. So we're going to increase the amount of cash, so that's going to be a debit on the left-hand side of 4,200. Now our revenue is going to be accretive or adding to our equity. So that is going to be increasing in credit. So it's going to post on the right-hand side of our T account. And revenue is going to be a separate T account here. Now we're going to have expenses associated with our operations as well. We're going to pay cash for those expenses. Cash is going to be decreasing for the asset. So it's going to post on the right-hand side as a credit. But first, we would post the expense as a debit for 1,000. Expenses would decrease the amount of equity available for our shareholders. So it's going to be decreasing to equity and post on the left-hand side. Now, if we paid salary expenses in cash, again, salary expenses similar to what we saw with the rent expense, it's going to be posted to the left as a debit, which is going to be decreasing what's available for equity. And we're paying cash for that amount, so cash is going to be our credit, and it's going to be decreasing that by $700. And now if we provided our consulting services and rental services, and then essentially issued an IOU, we would list, similar to what we saw before, those consulting revenues and rental revenues as credits. We're going to use the existing T account for consulting revenue. We've got a separate T account that we're listing here for rental revenue, so we're keeping those two revenue streams separate, which some businesses do, some industries do. Both are going to be credits. Both are going to post to the right-hand side of the respective T accounts, and both are going to be increasing in credits. The IOU as an accounts receivable is going to be a separate asset, a separate accounting line item here. So we're going to create a T account for it because it's an asset. It's going to be increasing in debits. The debit's going to be on the left-hand side. So we're going to post that on the left-hand side. Receipt of cash on account. So if we're owed $1,900 and are paid $1,900, we're going to increase the amount of cash that we receive by $1,900. So that's going to be a debit, post on the left-hand side. Accounts receivable is going to decrease the amount in which we're owed. So that's going to be a credit on the right-hand side, decreasing the amount we're still owed because we've been paid. If we make a partial payment to our accounts payable, we are going to pay that with cash. So cash is going to be our credit, decreasing on the right-hand side for $900. We're going to have a debit for accounts payable of $900 because accounts payable is a liability. It's increasing in credits. Our debit is going to decrease the amount we owe for the accounts payable by $900 and post to the left. We make a payment of a dividend. The cash payment is going to be our credit, $200, posting on the right-hand side of cash. Dividends are going to be decreasing in the amount of equity that's available for shareholders, so it's going to post to the left-hand side as a debit. Receipt of cash for future services. So here, this is kind of like the gift card or maybe putting money on an app to use later. Example, we're receiving $3,000 in cash, but we have not provided those services yet. So this is not going to be earned revenue. So we're going to create a separate T account called unearned revenue. That unearned revenue is going to get considered as a liability. So unlike, or similar rather to where we're talking about suppliers' money or we're talking about the bank's money maybe, this is kind of going to be like customers' money is why it's considered a liability. So the unearned revenue, though, is going to be similarly increasing in credits. So it's going to have beginning balance on the right-hand side, ending balance on the right-hand side. Our $3,000 of unearned revenue is going to post to the right-hand side as a credit and increasing in credits. And then we're going to have the $3,000 cash we receive posting as a debit to cash and increasing in debits on the left-hand side. Now, if we pay cash for future insurance of $2,400, we're going to have $2,400 as our credit to cash. And then that's going to post on the right-hand side, decreasing the amount of cash because we're not using the insurance yet. We're actually going to consider this as an asset, post it on the left-hand side, and create a T account and call it prepaid insurance. So we're going to have $2,400 that is going to be listed as our debit, posted to the left-hand side and increasing in debits. Purchasing supplies for cash, we would again increase supplies as a debit, posting to the left-hand side, and post cash as a credit to the right-hand side, decreasing cash. and paying our utilities expense in cash. Utilities expense is going to decrease equity available for the shareholders, so it's going to post to a debit on the left-hand side. Cash is going to be our credit, posting on the right-hand side and decreasing the amount of cash. And then payment of the salary expenses in cash. Those salary expenses are going to get debit on the left-hand side for $700, and cash is what we paid. Cash is going to be our credit, posting to the right as a credit, decreasing the amount of cash. Now, that's how we walk through each of those transactions and kind of what double entry accounting is going to do in terms of the impact that they have on the accounting equation, as well as our financial statements. I do want to touch on use of these financial statements just a little bit, and specifically what we're going to look at here is something called a debt ratio. And that is going to give us a measure of how much a company has in terms of liabilities related to its total assets or its total underlying economic assets that it owns here. With a low debt ratio representing most of that is going to be funded with equity, with shareholder money, and with a high debt ratio representing that it's using other people's money. That might be a loan, or it might be leveraged through accounts payable and through other aspects like that. And the equation itself is just going to be the total liabilities listed on the balance sheet divided by the total assets. So your total liabilities listed on the right-hand side of that equation, so not including the equity portion, and then total assets being what's on the left-hand side of the equation, and then just a simple division. So we don't have to worry about averaging for these. And this, instead of being written as a percentage, convention is to write this as the decimal. So here for Costco, you can see we have 0.70. And 0.70 is not going to tell us in a vacuum whether that's a good number or a bad number. But what we can do is compare it against a similar company, something like Walmart, and say that they've got a 0.70 debt ratio. Walmart has 0.59. So they're perhaps a little bit higher in terms of the debt ratio than Walmart. That might make them a little bit more risky of a company in terms of the way that they're operating. We can also look to a year ago, 2 years ago, and see that Costco was 0.63, 0.67, and we can say that generally they're a little bit higher in terms of the debt ratio that they've had from the previous year and 2 years ago. So they might be a little riskier than they even were a year ago or 2 years ago. And then gives us a little bit of intuition in terms of the risk profile that they're using for the way in which they are essentially financing their balance sheet there. And that is going to conclude the lecture on Chapter 2.